Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Clive Thompson, who's a retired wealth manager from Switzerland. So, Clive, thanks for joining the podcast today.
Thank you very much, Anthony, and Happy New Year to you.
Happy New Year to you too. Hopefully, it's better than last, but who knows? At this rate, I don't think we're going to be talking about much positive stuff today. But my first question, throughout your recent articles, I know you've done some recent videos, you've been mentioning how the central banks are insolvent and starting to make large losses. And I think that's probably most apparent where you're based in Switzerland as well. I think they've close to $200 billion loss last year. So I guess, how is this happening?
Well, if we just look at the central banks, their balance sheets have been increasing a lot, as you can see on the slide. Is that slide showing the right way around for you, Anthony?
Yes, it is.
So we've had a pretty massive increase in the central bank balance sheets, and it's blown their capital in terms of a multiple of the capital out of all proportion. So we're leveraged, for example, with the Fed 200 times. That's a lot of leverage for any central bank. The problem with this expansion of the balance sheet is it's basically increased the money supply. We've got a lot more money in circulation, and that money's been finding its way into assets like property, equities, basically anywhere people can put their surplus funds. So we've had a massive increase in the supply of money in the system, and that's creating strains. And we're seeing the strains now on the central bank's balance sheets because they're actually losing money. And this is due to the leverage, but the reason they're losing money is that the interest rate they're paying their depositors, i.e. the money market funds and the banking institutions who deposit money with the central bank, they're having to pay them the market rates at the increased rate of interest that they've put up now. So it's now in the USA, it's 4.5% going on 5%. On the other hand, the interest rate that they are earning on their assets, which is the bonds they've bought over the last 10, 15 years, is a lot lower. So if I take the Federal Reserve as an example, they are earning approximately 2% on their bond portfolio, but they're paying out 5% to their depositors. The consequence of that is that they're losing money. We can see that on this slide from the Federal Reserve itself, where you see this is actually at the end of December. They'd accumulated losses of 16 billion so far. If I look at the updated situation to as of the 4th of January, it's 20 billion. So that loss is increasing by the week. Today's figure should be out later today. I'm expected to go to at least 22, if not 23 billion of losses. The problem with that is that it's wiping out the Federal Reserve's balance sheet, wiping out their capital reserves, which you can see is over here. My cursor over here. It's 41 billion, 42 billion of assets. So it's half gone. This is the capital reserves figure that you see down there. And they're hiding those losses up here in the liabilities section as a negative liability or an asset. And that's obviously dodgy accounting. And they've explained why they're calling the loss they've made an asset. They say, because when we make that money back, we won't have to pay it to the Treasury. So it's an asset. Obviously, that's the weirdest accounting I've ever heard of. Makes no sense, but that's what they're doing. But this loss is not really the totality of the problem. There's two more problems going on with the Federal Reserve balance sheet. One of them is a figure that we see here on the balance sheet. I'll just bring it up here. There's an item here on the balance sheet. You can see it, $314 billion. So that's many, many times their capital, and it's called unamortized premiums on securities held outright. It's on their asset side. What that means is they bought a bunch of assets at above 100%. We're talking about Treasury bonds. They bought them at 106%, for example. And they're writing down that 6% down towards zero over the life of the bond, which would be maybe a few billion a week. It's actually working out at $1 billion a week at the moment. But that 314 billion doesn't actually exist because the bonds they would have bought at a premium are all trading at a discount now. So they're never going to get more than 100% for those bonds. And they're actually worth a lot less than 100% today. So to call the premium they paid, the 314 billion worth of premium, an asset, is maybe it's legal accounting. It definitely is legal, but it doesn't make any sense because the asset isn't there. It doesn't exist. And it's certainly not going to exist in the future because those bonds are going to mature at 100, not 106 or whatever price they paid. So you can see the capital and reserves of the Federal Reserve on that item alone are wiped out many, many times. And this will be the same kind of situation with many central banks. And I'm now going to show you something which gets even worse than that. So I'm just going to bring up the maturity schedule of the Federal Reserve's balance sheet. So the top hand side here, it says over 10 years. These are the securities which have got a life of 10 years. And you can see they've got about 4 trillion of assets, which have got a maturity of over 10 years. Now, 10-year bonds are down more than 20%. So if I take 4 trillion multiplied by, let's say they're down 25%, 4 trillion times 25%, that means they've lost $1 trillion. If they lost 20%, they've lost $800 billion because that is the current value of those bonds. And now they're on the balance sheet of the Federal Reserve, they're carrying those bonds at the par parity value or the price they paid for them. That's completely legal. Nothing wrong with that because they should be held to maturity. But it makes no sense if they're doing what's called quantitative tightening, because if you hold an asset for sale, you're supposed to mark to market. And if they mark to market, they'd have that 800 billion or 1 trillion of paper losses, at least on their balance sheet, which they're obviously not going to show. So the reason they're keeping or not marking the losses that they made on the portfolio is because they're holding them to maturity, which flies in the face of the quantitative tightening, which means they get to sell them. So what we've got in the Federal Reserve's case is a central bank which has got a far less assets than its liabilities. And that's probably replicated across the world. I haven't looked at every balance sheet in the world. I've looked at the Swiss national balance sheet. They're still pretty solvent, but the direction of travel is definitely the wrong way. I suspect other central banks are a bit like the Federal Reserve and now are insolvent. They've got less assets than they have liabilities. What does that mean? It means the government is going to have to recapitalize. In the US case, it's the Treasury. So sooner or later, the Treasury is going to be asked to put its hand in its pocket, and they'll have to recapitalize the central bank. But where are they going to get the money from? Well, the central bank's going to lend it to them, which will increase the indebtedness of the United States, and the the Federal Reserve will then increase the capital. But that's, at the end of the day, increasing the size of the central bank's balance sheet. It's increasing the size of the indebtedness of the United States, and it's increasing the money supply. It's basically inflationary. So we have a lot of inflation going on, and something could crack before this happens. If I was a large bank like Bank of America, Goldman Sachs, depositing money in the Federal Reserve, I would have some concerns about putting my money into a bank which at the moment, at least, is insolvent. Now, I have a high degree of belief that the Treasury will step up and recapitalize, but it hasn't happened yet. And perhaps I'd go one step further and say if I'm a large depositor in a large bank which is depositing with the Federal Reserve or a money market fund, because money market funds deposit with the Federal Reserve, I would have some concerns that the assets that they have deposited, there's a risk they might not come back.
Yeah, it's scary to think. And this might be my naivety, but could the Federal Reserve just print more money to pay that back, or is that not their role in the system?
Well, as they print money, it becomes a liability on their balance sheet. So they don't just print money. What they do, they print money and give it to the Treasury, who gives them in exchange a Treasury bond. But that's not solving the insolvency problem. all that's doing is creating more money, more assets and liabilities on the Federal Reserve's balance sheet. But if they did that, it would certainly be very, very inflationary. But it's not the solution. It's not. What's really needed is recapitalization.
Yes, I guess it's probably the only you could say company or place that could get away with having more liabilities and assets because they can just print more money. But as you say, that's going to have a far-reaching consequences on the rest of our monetary system.
Yeah. And as the Federal Reserve itself says, normal accounting rules don't apply to central banks. So they can do what they like. So this is why we have a lot of dodgy accounting by corporate standards. The kind of accounting I'm seeing here on the balance sheet is just not allowed in corporate accounts.
Yeah, no one will question them because they have what, like 20,000 PhDs or something. But so do you see that the central banks are sort of in like a bit of a death spiral? There's no way they can get out of this. They just have to basically do what we said before. They have to go to the treasury, get more bonds, more liabilities. Then from there, it's going to devalue the currency even more.
Well, the central bank can continue playing the game as long as the treasury plays the game with them, or the government plays the game of. Uh, uh, but the real problem is it's not the central bank which is in a death, so much of a death spiral, but the government itself. Around the world, governments have borrowed way too much money. They are indebted, and they are moving into the death spiral. The reason that's happening is because interest rates are rising, and as their bonds, which are paying 1 or 2%, mature, and don't forget these bonds in Europe were negative rates, as they mature, they're going to have to borrow at positive rates. The situation is that governments are struggling to pay the interest on their indebtedness, and with higher interest rates, they're going to struggle even more. So it's only a question of time before some little boy shouts, "The emperor has no clothes," and everybody says, "I don't actually trust the government to repay." They're going to do something, and they're going to go bankrupt, or they're going to wipe the slate clean. Or the more likely scenario, as I see it, is we'll have a currency reset where they issue a parallel currency, and we'll come back to that, and it's bottlenecked, so you can't get the old currency into the new currency, and then they can slowly wither away the old currency by printing it out of existence while running the economy on a brand new one. But we'll get to that a bit later, shall we?
Yeah, I guess that's probably the most extreme case. Do you see that there's a potential maybe for, and I think that that's probably part of it as well. They could go into bail-ins. They could do all these factors to try and reduce the debt. I guess longer term inflation for 5, 10 years, as we saw after World War II in the 50s and 60s. Could you see that happening, or you think that's probably not possible in this current state?
Well, the present plan is to kick the can down the road and hope that the system continues as is. And I think, even if they won't say it, there's a hope that through inflation they can wither away. That's the government will reduce the size of its indebtedness versus GDP. But it's not. That's not a new plan. They've had this plan for decades and decades and decades. If we go back to shortly after quantitative easing which was in 2008 to bail out the banks, in the United States, debt to GDP rose massively and went to nearly 100%. And US Congress had a plan at that time called the Debt Reduction Plan, which was going to bring the debt to GDP ratio down to 60% by about now. Well, that was it. Back then it was nearly 100%, and now we're at 130, 140% of debt to GDP ratio. So the amount of debt of the government has been rising much faster than the GDP of the country has been rising. So they've gone in completely the wrong direction from the plan. So even though they hope that it all inflate away, the reality is the problem as a percentage of GDP is getting bigger and bigger, and we've passed the point of no return, I think, in most countries. So it's just a question of time before they have to take more drastic action.
So you think we're quite close to that drastic action needing to be taken?
Well,
Relatively?
yeah, there's three courses of action, two of which are politically unacceptable. One is to raise taxes massively, and when I say massively, to such a point you destroy everything in the economy and you have a revolution on your hands. I don't see that happening, but obviously it's a way out. The second possibility is to simply default, And many countries around the world have done that in history. And the there's fourth possibility. The third possibility to keep debasing the currency by massive, just printing and printing and printing and try and print it away by expanding the money supply as fast as they can. But that's not really the solution because it will create an inflationary spiral. And the last option is the resetting the currency, where you have a new currency running parallel with the old one. And that's perhaps where we should start talking about the CBDC as a possibility, a possible way of doing that.
Yeah, definitely. I guess if I'll ask one more question, because I spoke to someone recently and he's saying he was talking about the debt ceiling. That's issues coming up in the US in the next couple of months. And normally what the Treasury do is they'll actually reduce the amount of cash they have on the balance sheet, almost to sort of put pressure on politicians to say, we need to resolve this. We need to fix this. So that they normally go from, I think it's around a billion, sometime a trillion, sorry, down to 100 billion or less. So you could say that's sort of a catalyst potentially if the Fed needs the money and the Treasury doesn't have it at the time. That could be a catalyst for this to occur.
Well, we've been there many times before. And when it happens, sometimes they raise the debt ceiling quickly, and sometimes they don't. And when they don't, they take some action. They shut down the national parks for a month or something like that. And then they do raise the debt ceiling, and the national parks open up again, and so on. I expect much the same sort of to and fro this time around. The Treasury will want to, or will be told exactly to not borrow anymore, but it'll be backwards and forwards, and eventually Congress will authorize the raising of the debt ceiling. It's been the way it's always happened.
Yeah, so should be resolved. So if we go to, you mentioned there the CBDC and how central bank digital currency and how that could sort of be the start of the monetary reset. So do you maybe want to talk more about that and I guess how it would come into play or how governments would look to implement it?
Sure. So let's just sort of go through a little bit of history of money here. I'll just bring this slide up here. Here we go. So if you look at the slide, we've gone through throughout history a period where we had coins as our money, gold and silver coins, like the ones you see here. And we then moved into paper notes, like that. And we're now pretty much digital in a certain sense with our credit cards. But the next step is certainly going to be a move towards electronic money from the central bank, which is not the same, I would like to stress, as the digital money that we're using in credit cards. It's different. So the CBDC is a direct liability of the central bank. So it's like the banknotes that you have in your pocket. The banknotes in your pocket are on the Federal Reserve's balance sheet as a liability. Those banknotes over time are going to disappear and be replaced by CBDCs, which will be on the Federal Reserve's balance sheet as a liability. Sitting alongside that will be all the other types of money that we have today, which is the money you have in your bank. So when you spend money, you'll be either spending your credit card, which is taking the money out of your bank, whether it takes your CBDCs out of your bank or your money out of your bank, which is not the same as the CBDC, that'll be depend on the credit card. Just like you can have a credit card which might take euros or might take dollars, two credit cards. So it depends on what the credit card is debiting. So it'll either be debiting your CBDCs in your bank or it'll be debiting your old dollars or new dollars or whatever they are. So the advantage of a CBDC is it will be possible, even more efficiently, to move money from A to B instantly. But from the Federal Reserve's point of view, it will be different from the cash in circulation, where it doesn't know where it is. The Federal Reserve and the Treasury will know exactly where your money is. And not only that, it will be programmable, so they can increase the interest rate on it. They can reduce the interest rate on it instantly. They can tell you to expire in 3 months if you haven't spent it. They'll be able to make up some rules. If they don't like you, if you happen to be a Colombian drug dealer, they can instantly and quickly freeze it. If you've said something wrong on Twitter and criticized the president. Who knows what they might do as a punishment to your CBDCs. They might limit the amount you can spend. There's a lot of things that could be done, but of course they will potentially know everything you spent, where you spent it, and how you spent it. And that will make the collection of taxes a little bit easier, because if the amount which is passing through your digital wallet, either in your bank or in your own digital wallet, is odd relative to what you're putting on a tax return, of course, that'll be a nice comparison for them to do. And last but not least, if they decide to go to automatic tax collection, they could just simply say, our taxes this year, we're going to cancel every digital dollar with the ending in the letter E, for example. And that's ours.
Yes, that's really fascinating. So I guess from most people's perspective, it wouldn't be very different unless they were to start implementing these rules. So I guess, do you think that's how they'll get it through? They'll just say, oh, it's the exact same as previously. And then later on is when they can implement these rules potentially, or what's your thoughts on that matter?
Well, a lot of privacy type people aren't going to like it, and I understand that. But the public at large generally aren't bothered. They're used to using their credit cards, and their credit card company knows what they spend their money on. And that information is obviously available to the government if they ask the credit card company anyway. And likewise, when you go onto any website, whether it be Google or Facebook or anything else, you get a little message popping up about cookies and this, that, and the other, and you can read the privacy concerns. Nobody reads it. They just click OK or accept. So for the average man in the street, he's not really going to care very much about those privacy concerns, but it will take some getting used to. So the way I suppose they'll work it, they'll go with the CBDC. We'll have a test phase. That'll be phase one. Then they'll start to roll it out, but everybody will be able to use the CBDCs alongside banknotes, alongside their credit cards, which will be then either linked to your CBDC in your bank or linked to the dollars in your bank. There is a difference between the CBDC in your bank and the dollars in your bank. The CBDC in your bank is yours. The dollars, or the old dollars in your bank, is basically the money which the bank can go and lend out to some spotty teenager to buy a Xbox or whatever they want. So you'll have a choice of high interest rates with your bank or low interest rates with the government backed currency, and you'll take your pick. So if people fear that the banks are about to go bust, they'll probably have their own personal CBDC wallet and keep all their money in their own wallet. But on the other hand, if they want to earn some interest and want to invest their money more in various ways, they might allow the bank to have it and lend it out.
Yeah, it's interesting. And how does this solve the debt issue? Because it seems like if it's like for like swap, then that doesn't really solve anything.
You're right. So the CBDC on its own doesn't change anything relating to government debt or the Federal Reserve's balance sheet. It's just effectively over time changing the banknotes as people stop using them voluntarily, I'll say, rather than by order of the government. It just changes the banknotes for digital banknotes, which will be on your telephone. That's it. But the other side of the coin is it will make it a lot easier for the government to reset the currency. Why is that? Well, firstly, let's talk about the need for a global reset. The World Bank, Bank for International Settlements, and others are calling for a debt restructuring. Governments in the Western world are way over indebted, and I think companies and individuals, to some extent, have too much debt. If the government has a crisis where people are no longer trusting the currency, and that could be not trusting the CBDCs as well, because CBDCs will be the currency. If there's a crisis, people are rioting in the streets, they're burning the cars, the shops are empty, the food prices are too high, they can't pay their electricity bills, they don't like their taxes, whatever it happens to be. It may be that a country somewhere, could be Italy, could be France, could be Japan, could be even the United States, who knows? Could be my country, Switzerland. It could be that a country decides, you know what, we're going to appease the population. First of all, to stop the run on the shops, we're going to limit how much of your old currency you can move into the new currency, the CBDC. Call it £1,000 or $1,000 a week. Plus, of course, you've got your salary coming, but what you can't do is move massive amounts of all currencies into the CBDC, which could allow you to go down to the shops and empty the shops. And we're also going to credit everybody's wallet with some free money and go out and go out and enjoy yourselves. Here's a present from the government. So sort of we call it maybe the first step towards universal basic income, UBI, which they'll be able to do if you have your personal wallet. They'll be able to give everybody $500 a month or whatever figure they decide to do so. Of course, they'll be able to take it away from you in the same vein if they want. But if we get to the point where a currency reset is necessary, it would make no sense for all the old money to be converted to the new money. So that means if you have debt, like government, if the government has bonds, treasury bonds or whatever, which they've issued, which is the liability of the government, it'll make no sense that that can be converted to the new currency. Otherwise, they've achieved nothing. So those assets will stay behind in the old currency and gradually wither away as they tighten the rules about what you can convert to the new CBDC. So they might say you can convert some old money to the CBDC, the new money, if you're buying a house. They might say you can do it if you need it to live on. But if you have, according to our judgment, more than you need, you'll have to wait, or you'll need permission, or you'll have to fill in some money laundering forms, or we'll have to make sure you paid all your taxes on it. They'll make up some rules which basically will ensure that not all the money rushes into the new currency, destroying the economy in the way that the economy is being destroyed by the old currency. If we take that by extension, that we now have two currencies and debts are left behind in the old currency, that wouldn't just apply, or hopefully wouldn't just apply to the government. It would hopefully apply to the debts of individuals and hopefully apply to the debts of corporations. So in a perfect world, we might end up, and this is good for the people who borrowed money, but not good for the people who hold the other side of the coin, the asset holders. But in a perfect world, from the borrower's point of view, everybody who's borrowed money will find that their liabilities are left behind in a currency which isn't worth as much as the new one, because you can't actually spend it. You're bottlenecked. You can't move more than a certain amount of the old one into the new one, and therefore the old one will be exchanging hands at a discount. If you want to buy a house, the seller might say, well, if you're buying my house, it's $200,000 in CBDCs, but if you want to pay in the old currency, well, it's hard for me to convert it back, so I want 400,000 old dollars. So that's going to trade at a discount, the old currency, and slowly that discount will get wider and wider until the old currency withers away to nothing. And more importantly, the government won't have the problem of worrying about how it's going to service the national debt, because it can now freely print the old currency away until everybody realizes it's all completely worthless in the old currency, but the economy is running perfectly fine on the new currency, and we don't have to worry about the old currency disrupting or causing inflation in the new currency. Of course, in the old one, you have a lot of inflation. As it goes to zero, the price of everything goes to infinity, but that doesn't really matter because the economy is running on a new currency which isn't affected by that. But the government slate would be wiped clean. Now, you can imagine how good that would be, because the debt to GDP ratio goes from 140% to, in theory, zero. It won't actually be zero because there'll be a lot of bail-ins for those who've lost money. So pension funds are undoubtedly going to be bailed out by the government. So that takes your debt to GDP up a little bit. There'll be a whole bunch of people who are losers on this, pensioners, people who've got savings in the bank, and some of them, the preferred sum, because the government will make up the rules who wins and who loses, will get some kind of compensation. So that debt will come back in the new currency, but it will be nowhere near as high as it was in the old days, because they won't have to spend all the money they've been spending over the last 25 years to bail out those who need bailing out. I think that what will happen is when we do get the new currency, salaries will have to be paid in the new currency, which are called CBDCs here. Shop prices will have to be in the new currency. You'll have to pay your taxes in the new currency. And your liabilities, your old credit card debt, your old mortgage, and corporations, bonds, and government bonds will be left behind in the old currency. Won't affect banks much because they will still be balanced. They have assets on one side of the old currency, liabilities on the other side of the old currency. Still, their balance sheet will still be perfectly attuned. They'll just have a new kind of asset on their balance sheet, which is turning up from nowhere from the start of the new currency when it's reset, which will be, we'll call it for the sake of argument, the CBDC, or the new dollar. So the banks will still be able to operate and continue to do what they've always done, but the old currency side of their asset sheet, both assets and liabilities, are going to wither away to nothing over time.
So you don't see the central banks, because sort of when I was hearing you speak, it could almost be the central banks, have their own wallets, and then there's no need for banks. You don't see that happening. You see them still being a vital part of the system, or in the short term.
We mustn't forget the financial institutions are enormous in size. They're even compared with the Federal Reserve, or much more so. And they are the powers that be. They're not going to put themselves out of business. No way. They're not going to allow the government's in the pay of these people. The government is not going to put them out of business. Everything will carry on. Of course, one side of the business will wither away slowly. That's in the old currency, but the new side of the business will be moving on and being created just to replace the old side over a number of years. I don't know how long it will take for the old currency to wither away. It could be fairly quickly, could take a long time depending on the rules. Certainly, if the government says you'll be able to convert some of your old currency to the new currency later, with that promise, it will have a value.
Yeah, this is really, and I can imagine this would be very popular for the average person, saying, "Oh, it's basically a wealth tax. It's a reallocation of wealth from the wealthy to the average person." I guess the challenge as well is asset owners. So if people own assets, how would that affect them? So let's say equities, let's say houses. Would that still be detrimental for them, or they might just convert to different value of the new currency?
So tangible assets will still be a tangible asset. So before the reset, if you own a bar of chocolate and it costs $2, old dollars, after the reset, you'll still own that bar of chocolate and it will cost, let's say, 2 CBDC dollars. It's the same thing, but you still own the bar of chocolate. Of course, that bar of chocolate might now cost, if you were allowed to spend old dollars in the shops, it might cost 5 old dollars in the shop, because the shopkeeper's going to say, I don't want your old dollars because I can't pay my taxes with them. So I want more if you buy that bar of chocolate. So if you own things, you'll still own them. And what are things? Properties, machines, animals, tools, gold bars, gold coins, silver bars, silver coins, equities, which are a share of a business. If you own bonds, that's something which is going to be repaid in the old currency, and we don't know what the old currency will be worth by the time it gets repaid, but certainly a lot less. And even when you get the money, you may find that, and probably will find, you can't convert it over to CBDCs unless you fulfill one of the many types of conditions which will exist, like proving you paid your taxes or anti-money laundering rules, or just simply you can't do it for more than X amount.
Yeah, it's interesting. I guess from your perspective, for people to protect their wealth during such a period, it would be putting their cash or their money going away from, I guess, fixed income, putting it into these assets. And is there any specific in general that you'll like that think as well, like gold?
Well, yeah, just show you a picture of gold there. I think that's if you can put it in your bank, you can keep a lot of money in a very small, in a safety deposit box in your bank. But I'd extend it to collectibles of all kinds. So it could be whatever. If you happen to know about a certain type of collectible, you could store value in that. Obviously, you have to be careful not to buy it from antique shops and sell it in auctions where you'll lose a huge amount. But if you buy it peer-to-peer and sell it peer-to-peer, you can probably buy things for the same price as you could sell them. Old currency. Here's a picture of some old English currency, which is pre-1947 in the UK. So it contains gold. There's a gold coin in there, but it contains silver. The old English ones are 50% silver. The old Swiss ones are 83.5% silver. The old French ones are 90% silver. American ones, I'm not sure what the silver percentage, but it might be 90 or 95 or 99% silver. Another asset which you could have is property. I certainly think that's a good place to park money. And if you already got your property and you can't afford a new one, you can think about doing a home extension of some sort. Antiques and collectibles could be a play to park your money. If you're buying property, I kind of think that you might want to look at the Airbnb type of property where you can get the tenants out. I do think that rents, if we have a currency reset, your contract for rental income will effectively be converted to the new currency by law, because the contract won't say that. But I think there'll be a law to pass to say all rents get paid in the new currency, just like the law say all salaries get paid in the new currency, which is not what your contract says, but they'll legalize that. And we mustn't forget the biggest landowners are politicians, amongst others, or the rulers. So they're certainly not going to say that the rents stay behind in an old currency. That is going to change over. But I would rather favor, just in case, the Airbnb type properties where you can get the tenant out of every week and set a new rent, because there is a risk we might see, for various reasons, rent controls coming in. It's possible. In terms of the stock market, it's had a very bad year last year. It's not very common that we get 2 bad years in succession. And if we get a new currency, it'll be very good for the stock market, because, first of all, corporations who have bonds out there, if those bonds are not by law convertible to the new currency, they'll have an asset or a liability in a currency which is withering away. It's a bit like having a bond in Argentinian pesos. It's going down in value every year because the currency is depreciating, and that's a profit. So companies will be making profits because their liabilities are going down, but as the liabilities go down, they'll be able to borrow more and invest more, which is good for the economy. The man in the street will be happy as a lark if his mortgage stays in the old currency, because that will wither away and it'll be costing him less and less to service his mortgage. So he'll have more money in his pocket. The government will be taking less money out of your pocket to pay for the interest on the national debt, because they won't have a national debt they care about anymore. It'll be in the old currency, so they don't have to bother with that. They'll have a new national debt, but the size of the new national debt will be much, much smaller than the old one. So they'll be taking less out of the man in the street's pocket. His old credit card bills up until the reset date will be in the old currency. So he'll be very happy that that's wiping his slate clean to a certain extent over time. So he'll have more money to spend. And as he spends more money, that means more consumption, more business for companies. So the turnover of companies should rise. So all in all, I think it would be rather good for the economy and therefore good for the stock market, and stocks should rise. Obviously, we'll perhaps talk about when this might happen, but because it's not imminent, but it could happen without warning. So I do think investing in stocks will be one of the things to consider. But what I'd like to stress to all your viewers is nobody should put too much into anything, because everything you invest in can be volatile. If we go back over time, and we just take the one example from the last 12 months, you can see that the different asset classes that you see here, some went up a lot and some went down a lot. And if we now move over to what's happened in recent years, I'll just bring this slide up. Make that bit bigger. You can see that we've had some years going back to 2015. You can see we had different types of assets went up and down. So, for example, some years wine was a very good investment, and some years oil was a good investment. Some years gold was a good investment. Last year, Bitcoin was probably the worst investment you could have had, but it's hit the jackpot a number of years, as you can see at the top of the slide in orange. So, first of all, I'm saying if you do invest money in other things, including the stock market, be diversified. If you're in the stock market, be diversified by country, be diversified by industry, be diversified by style. Style means you have growth companies, you have value companies, you have income generating companies, you have companies with high margins and so forth. So you need to make sure that you've got large companies and small companies. So be diversified in all those respects, and don't just own equities. Don't just own gold and silver. Don't just own property. Try and have a mixture of everything you can. And if you still can't find anything to invest in, see if you can pay your taxes in advance. That's a good move. Or pop down to the shops and find things you might need next year or the year after that, and spend your money now rather than waiting for the currency reset when you might find your money stuck in an old currency, you can't change it. I don't think this is going to be a worry for the average guy. The man in the street's not going to have enough money to be punished when the reset comes. He'll be able to change. If you've got £5 or £500 or $500 or $1,000 or even $10,000, you will be able to change it. But if you've got hundreds of thousands, I think you're going to be bottlenecked, and you will find you'll have to wait, or not changed at all, of course.
Yeah, definitely. So you mentioned it before time. So do you have like a period when you think this is more likely to happen?
When currency resets have come in the past, they've either come slowly because the inflation rate's been running out of control, and eventually the government has no choice but to do something about it, in which case it's, in a way, it becomes self-fulfilling because people start to realize it's coming. And we've had countless examples of that in places like Argentina, Brazil, and others. But then we've had places where it's happened fairly suddenly, such as in 1948 in Germany, where almost without warning they brought in the new currency, the Deutschmark, at least in the Western zones, the American, French, and British zones, and the old system of barter, which was operating in the destructed Germany at the time, which was, with cigarettes and things like that, instantly came to an end. But of course, when that happened, it wasn't like you could change your old marks one for one into the new marks. I haven't got the ratios in my head, but I think it was something like 100. The first 100 marks could go one to one to the new currency. The next 100 you got 60, and the next 100 you got 6. So, but at least that was a sudden reset, and people couldn't prepare themselves in advance. But if they had been able to, they would have pushed as many things as they could into tangible assets before it happened. Now, how could it happen suddenly without warning? We could have a lot of trouble. People could be queuing outside the banks. Let's take February 1933 in USA, for example. People were queuing outside the banks to get their money. It was the Great Recession. People didn't trust the banks. And to try and resolve things, President Roosevelt declared a 1 or 2 week bank holiday. He shut the stock market, and people suddenly realized, oh my God, I've got all these dollars, but I can't do anything with them. And they still didn't know that a couple of months later, they were going to be told to hand in their currency, i.e. their gold in those days. They didn't even know that was coming, but they suddenly saw the door closed on them and they couldn't do anything. So when the stock market opened 2 weeks later, after they tried to solve the crisis of the people queuing outside the banks, the stock market took its biggest leap, one-day leap in all of history. But by now, people realized there was something up. And we had, as time moved on, the restriction where you were told to hand in all your gold to the government and get Federal Reserve paper instead. And of course, people weren't, this was new and people didn't expect it. So the stock market then had its fastest ever 100% rise in all of history. It took about 3 or 4 months for the market to go up by 100% as people tried to redeploy these now devalued dollars. And then a lot of people knew what was coming, but they tried to redeploy these devalued dollars into something. They wish they'd done it before. In other words, they wish they'd done it before the reset, but they didn't. And even then, they didn't know what was coming next, because in January, at the end of January 1934, the US government devalued the dollar by 58% in a single day, one day. Now, it wasn't like today where you have global currencies all over the place and changing hands in microseconds. America was American. People had dollars in America. They had marks in Germany, and they had francs in France, and so forth. Today is a much more global and interconnected system. But it was very good for America, because suddenly their currency was worth that much less, which made American goods and services seem very cheap to the whole world. And it led to the way out of the, over time, it led to the way out of the Great Depression. But those who, if you happen to be in Europe holding dollars on that day, you lost 50%. It would buy 58% less of everything American on that day. So we can have a sudden, it's happened before, and it will happen again. We might have a sudden reset, in which case you need to prepare yourself gradually before it happens, because you might wake up one morning and find that the banks are shut down. They close for a week or 2 weeks while they sort out the mess. And you're thinking, well, I wanted to put my money in the stock market. So the stock market was crashing. It was really cheap, and I was waiting for my opportunity, but now it's gone. Then the market opens, and suddenly everything's a lot better. Yeah, so I say, get ready, invest in what you can. The things to get rid of are your bonds and your cash, but not completely. I'm not suggesting that anyone gets rid of all of it, because you need to live. And when things start to go wrong, you might find you've got to survive for a period of a few months or weeks. And you need to be able to go down to the shop and have something to spend. And you might have an emergency where you need a lot of money. So it depends on your situation. If you have a job, you might feel you need less savings or less in the old in currency. Whereas if you're out of work and you're living off your capital, like a pensioner, you might need a lot more. So each individual should keep some cash. It's not like I'm saying to people get to zero, and even less so, I'm definitely not saying borrow money. Now, I think a lot of people might have jumped to the conclusion from what I said when they heard that their debts might be wiped out, their mortgages might be gone. They'd probably jump into the conclusion, oh my God, I should lever up and borrow as much as I possibly can and invest the whole lot in silver and gold, and I'll make a ton of money. Well, there's going to be some problems with that. The first problem is, if a currency reset itself is probably born in a crisis, out of a crisis. So when you have a crisis, it could be give you one example. It might be a collapse in the government bond market, because some people will know that the reset's coming. They'll be getting out ahead of time. They'll be profiting from it, and the word will be out, and the bond prices will be falling, and that will be the death spiral that creates or forces the hand to make it happen. If you have borrowed money, watching your interest rates go up and up rapidly will hurt like hell. We mustn't forget this happened in the UK when Britain was trying to get or be part of the euro. It was in the what's called the European ERM exchange rate mechanism, and they were trying to hold the pound at a certain level, and there was pressure on it. So there was, people were shorting the pound because the balance of payments wasn't that good, and it was going to risk leaving the narrow band against European currencies. So what did Britain do? As things started to get more and more precarious, they raised the interest rates from 8 to 10%, and then we had George Soros came in and shorted the pound to the tune of $1 billion or whatever it was, and they raised the interest rates in the morning. I think I don't remember the exact rates, but I think it went from 10 to 12, and in the afternoon they raised it to 18%, and by the evening the pound had crashed out of the ERM. It dropped by, I'm not going to say the figure, 15, 20, 30, even 40%, I don't know. It went down a lot. And they lowered the interest rate back to 8% within a few days or weeks. But imagine that high rate of interest was to last for months and months. That would really, really hurt those who borrowed money. And you might find, because of the high interest rates, the assets you bought are falling in price. And your bank says, look, you borrowed money on the back of this property or on the back of these equities. They've fallen in price. You don't have enough assets to cover your liabilities. We'd like our money back, please. Sell your assets. We'll get back what we can. Or they'll force you to sell your assets, or they'll sell them for you if they've got control of them. And you find yourself sold out into the old currency at the worst possible moment. So definitely, I'm not recommending people to leverage, but there is a second problem. Let's say that does work. Let's say you borrow a bunch of money and buy silver coins, expecting to make a big profit, and sure enough, they have the reset, and your old currency is worth almost nothing. And you've now got a bunch of silver coins, which have cost you effectively nothing. Sounds great. Well, people are going to hate you for that. The public at large will have missed the opportunity to do what you did. They'll feel that you're a hoarder or a profiteer, and there'll be a great deal of hatred because they missed out on the opportunity. The newspapers are going to hate you. They're going to say, "Look at these people who knew what was coming and they profited from the situation. How wicked!" And the government is going to come down on these people like a ton of bricks with a with a windfall tax. You'll have to pay if you took advantage of the situation. You'll probably find you have a maybe up to 100% windfall tax, but certainly there will be windfall taxes on those who profited, and those windfall taxes could also fall on those who didn't deliberately profit, but just happened to have the right type of assets at the right time. It's hard to say how that will work out, but you can imagine the public opinion will be very strongly against those who, inverted commas, took advantage of the situation. And there might be different rules for those who borrowed money in the 3 months prior to the reset and those who borrowed 5 years before, because one could argue that the ones who borrowed 3 months prior to the reset were in the know, and they might get more heavily penalized, or they might just see by law, their liabilities converted to the new currency, whereas those who did it 5 years before find their liabilities left behind in the old currency. And so we don't really know which way it'll work out. We mustn't forget there's more than 100 countries which are going to do the CBDC. I think it's 150 I saw somewhere. But when one country has a reset, everybody in every other country will say, "Oh my God, we could be next. I must do something." And that will precipitate the panic everywhere in the world. And that means that every country will have to do a reset almost at the same time.
Yeah, it's crazy to think. So, Clive, thank you so much. We've covered so many topics, and I think we've definitely gone into intricacies of CBDC and how it could be implemented. So, my last question is, what is one message you'd like people to take away from our conversation?
I think be diversified, hold multiple asset classes, reduce your cash and bonds to a lower level if you don't need it immediately.
Yeah, that's a great message. So, Clive, thanks again. If anyone wanted to find more of your work or what you've been talking about here, where would the best places for that be?
I write articles from time to time on LinkedIn. I've written half a dozen in the last month. So anybody who's on LinkedIn can click on my name and follow me.
Perfect. I'll put that in the description below. So, Clive, thanks again.
Thanks very much, Anthony. Bye-bye now.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.